I'm going to lift my target. And I don't mean lower it. I mean, probably lift it. And I'm not going to put a number on it. I'm just going to say that I think silver will go berserk. And the reasons are, there's multiple reasons. We can get into those. But yes, and the action last week turned up our intermediate trend metrics, momentum things. Now, what I mean by that is when you look at long-term analysis of silver and gold bull trends, like annual momentum, so forth, the break was a nice break, but it didn't break anything, didn't break any structures on momentum. So the long-term trend remains positive. That was a negative zigzag and a positive trend. So, but when we go down to more intermediate technical factors, things that come and go in a matter of a couple months or several months, they turn negative. They turned negative about in March, really, prior to that war break. Okay. But since then, if you stand back and look at a silver or gold chart, go back to that break that occurred in late January, early February. It was really about a 2-day break. People don't realize it was like 2 days, bam. Silver hit a low of 63.90. Whew, you know. And then went back up to like $90 and it came down and made another low at about 61. Didn't fall apart and turned back up again. Teasing rally. Then came back down again, got to about 56. Okay. But right now we're trading 65. Okay. We're back above those lows, all the lows that occurred, the sequence of lows. But if you think about it, all those lows were like marginal teasers. The real low occurred 2 days after the high in February. And so since then, you could draw a line sideways on silver and say, well, yeah, it's still under pressure, but it really isn't going down much since 6 months ago. Okay. So somebody's been buying that beast down there. Okay. Same with gold, same sort of pattern of a low in early February, then another low in March, and then you get the point. The upturn we just had last week, on most people's charts say, well, it's just another rally in this nonsense range. You know, it's no good. It's just a sell the rally. Okay. But when you look at momentum, it says, no, this one's different. This is a rally that will likely sustain and work its way back to and through the highs. And I don't think it's going to take a long time. I think it may take like a month. Suddenly you're back up well off the lows and challenging the highs. But forget that. The issue is, where are we going?
Here's an anomaly some technicians keep pointing back to. Nearly every other industrial metal, copper, zinc, aluminum, lead, steel, now trades at roughly 4 to 6 times its 1980 price level. Gold sits comfortably above that multiple too. Silver, by contrast, has spent much of this year barely above its 1980 peak near $50. The argument goes that if silver were simply keeping pace with the rest of the metals complex, it would already be trading dramatically higher, a gap some analysts chalk up to structural mispricing rather than any real lack of demand.
And a lot of people make the mistake of taking out their old daily price charts or weekly charts from 1980 or that second high we made at $50 in silver in 2011. And they say, well, you know, we just collapsed just like that 1980 peak, and it took them decades to get back up again. Okay. Well, you know, that's assuming, don't look at the old arithmetic charts. Look at a ratio scale chart, a percent scale. We've run these charts before, but think about this just for a moment. You don't have to be a technician. Metals. Let's see what metals here I got. These are just examples. Lead, steel, zinc, aluminum, copper, all base metals, and gold. Where are they trading right now versus where they made their highs back in 1980? About 4 times that price level. Okay, 4 times. Gold's more than 4 times what its bare low was in 2015 or where it was in 1980 when it made a peak at 850. Multiply that times 4 and you're above that level. Silver's what? Trading 10, 15 cents above its 1980 high. So let's say silver made a mistake. supply-demand mistake. We know we have a deficit. It's been for 6 years or so where we're not producing enough silver to match the demand. And yet that's ignored. The fact that most metals on the planet are 4 times where they were in 1980, and yet silver is overdone, with a pullback recently to a 6 cents above its 1980 high. I mean, give me a break. Okay, so what caused that? Well, I don't have the answer. Some people I respect do, and they argue it's been actually manipulated by major banks, perhaps working in shoulder to shoulder with the central bank. I don't know. Forget that issue. But obviously, silver, for some reason, has not moved in reality with every metal on the planet. And its mama metal in the monetary sector, gold. It moves with gold, right? Okay. Well, how come when silver back in 1980, for example, was what? 6.5% of the price of gold. Divide an ounce of silver and an ounce of gold. Where's silver right now? About 1.5%. What's going on here? We don't need silver anymore? It's not money anymore? No. Silver made a mistake. And therefore, to get back to the first issue about where we're going. Even if it went up fourfold, which would put it, $200 silver above the $50 high, that would be normal. But most markets don't move when they make a big mistake for a protracted period of time, like way too high for too long or way too low for too long. When they compensate for the mistake, they often do 2 things. One, they compensate with speed, that sometimes is shocking, and 2, an overshoot of reality. Okay, and of course, if silver goes up in another leg here, another extension of this repricing new reality, these other metals aren't going to be sitting there at 4-fold. They'll probably be at 6-fold, 7-fold versus 1980. So silver's not going to go to 200 4-fold. It's probably going to go much higher. And I don't want to pin a number on it. It wouldn't shock me, don't chuckle, if you had $1,000 mark on silver at some point in the next year. Okay? Because there's a lot of things going on out there. We can get into that.
One way to measure that gap is the gold to silver ratio, how many ounces of silver it takes to equal 1 ounce of gold. Back in 1980, that ratio sat near 15 to 1. Today, it remains far wider, reflecting how much silver has underperformed relative to its historical role as a monetary metal. Compounding this, the world has now run consecutive annual silver supply deficits for roughly 6 years, according to the Silver Institute, as industrial demand, driven heavily by solar panel manufacturing and electronics, keeps outpacing mine output. Markets that stay mispriced for years, analysts note, tend not to correct gradually. They tend to correct all at once.
I think it's legitimate. I think it's somebody looking for an excuse to why silver didn't go up like gold. Okay? And so they say, whoa, China's buying gold, not silver. Okay, well, I think India is actually heavily involved in silver right now and even moving toward monetizing it maybe. But for 3,000 years, silver's been money. Poor man's gold, okay? With official government stamps on it even, okay? So no, I don't think suddenly now because somebody wants to explain why silver didn't match gold, it's not money anymore. We suddenly decided. Well, we'll see, okay? I don't accept that argument. I think what's going to happen is silver's just simply made an error. A lot of markets do. And whether that was in part manipulation, but it's when it unleashes, it goes to a new reality. It likely will overshoot that reality even. But I'm looking at various metrics, not merely that if all these metals are 4 times their price in 1980, well, they're not stopping either. Copper's continued 6 times where it was in 1980 right now, okay? 1980 was $1, okay? So the point is that silver, if it's compensating for that major error, pricing error, relative to anything, relative to all these basket of base metals, gold, etc., it likely will do it with speed. And I suspect that when that event occurs, and I think it's coming, I think when we come up out of this congestion, and already we have signals that we're coming up out of here. Okay, you can wait till the new high if you want to. But on the other side of this congestion zone will be something that will drop jaws. And be so rapid, so quick that people just won't understand it. But at that point in time, I'm going to bet that certain other fundamental factors come into play that already are in play, but have been long ignored by investors and analysts and talking heads on financial TV. Mainly monetary crisis, debt crisis, government debt crisis. We haven't had one of those in a long, long time. Okay. In 2008, the markets collapsed. Silver and gold went up, 2000 to 2011. But the stock market went down because of what? A debt crisis. But it was just mortgages. This time it's government bonds. This is a nuclear event. And it's only now marginally becoming sort of a sideline issue on financial press. It's so major it should be the front headline. It should have been for a year now. The Japanese went into the hole, and now suddenly we're going into the hole with them. In fact, we're helping fund them try to get out of the hole. We're printing money to support the yen so they'll continue to hold bonds, like a circle there, okay? It's a game. But it involves what? Printing money. That's what moves monetary metals. But that other side of that move in silver, when it occurs, I suspect you're going to start to hear the fundamentals that really matter. And I don't just mean the increasing demand industrial for silver, but I'm talking about the monetary crisis. And those headlines will suddenly come up to the fore, but silver will then be 150, 200, 250. And all of a sudden people say, oh, now I understand. Okay, that's usually the way it occurs. It rarely is that all the real truth headlines come before the move occurs. It doesn't happen that way. We're already there. It's just that nobody acknowledges it.
Right.
Jamie Dimon does. He said months ago, we got a bond crisis. We're going to have to deal with it. Okay. In other words, you can't keep pushing this thing down the road every 10, 20 years. We'll take care of it again. It's been going on for like a century now. And finally, it's reached a point where the Japanese have suddenly, like the prime minister over there said a year ago, we're going to print. Okay? And I know our current president would like to do that as well. Whatever it takes, keep that stock market up. Okay? And the Fed has already begun because they've been supporting the yen artificially. And that has helped expand the money supply. So I think those headlines will come, but we already are in the crisis, really. What we're going to hear later is the wave effects of the crisis. For example, at MSA, we're not just watching things like AI and semiconductors. Although it did give a good call on the semiconductors at the top. We're not far off the top. We said, that's it. Okay. The real issue is this underlying multi-decade government debt crisis and the jeopardy of the fiat currencies, not just Japanese yen, but us, Europe. We're all in the same soup. And it's just a matter of degree and when. Japanese first, us second, Europe's going to be next. But fiat currencies in a crisis like this will come into severe doubt. People say, well, this has been kind of neat for the last multiple decades, 100 years or so, but it ain't working. It's not backed by anything, and it's out of control, and all we keep doing is printing more of it. And, I probably said it on your show before that, when your granddad built a house, it was $4,500. When your dad built one, it was $45,000. Now a median home is $450,000. What does that reflect? Okay, degradation in the money unit. Okay, the stock market right now, S&P, for example, you go back to the year 2000, the dot-com high. Look at the multiple gain in the S&P, where it is now versus then, and then go back and look at an M2 chart and see where M2 money supply was in 2000 versus now. Oh, S&P has matched the decay in the money unit. That's all it's done. The S&P, I can't buy more loaves of bread now than I could back in 2000 with the S&P. Gold has massively beat that, stayed ahead of it. It's held its value. Silver's lagging, and that's where we get the slingshot. But anyway, it's going to be very interesting because there are many fundamentals out there that are all interconnected with this debt problem and the fiat currencies that will suddenly pop into play. We're watching financial sector. I mentioned the AI, which everybody's watching, and semis is the most watched thing. But you got to watch the financials in the key banks and also the commercial real estate market. ETFs like RWR, VNQ. There's something wrong there. And you can't allow, the Fed can't allow, any headline story to come out of a large bank. No, we're not going to go under because they'll print the money. But you can't have a major debt story about, major credit problem here. Another one. Oh, another one. Suddenly, the entire view of the investor public will shift. And they'll realize, they'll be ambushed, in other words, by a reality that's already been there.
Underneath all of this, some analysts point to a slower moving story: sovereign debt. Unlike 2008's mortgage-driven crisis, today's concern centers on government bonds themselves. Japan's ongoing yield curve pressures are cited as an early warning sign, given how heavily its central bank keeps intervening to manage its currency and debt load. But the concern isn't limited to Japan. Similar debt to GDP dynamics are increasingly being discussed across the US and Europe. Analysts tracking this argue that renewed currency printing to prop up bond markets has historically been one of the strongest tailwinds for monetary metals like gold and silver.
I'm rampantly bullish on the silver miners. My own personal investments, which are disclosed at the end of each report, disclaimer, are heavily in silver bullion equivalents and silver miners. I also own some GDX, it's an ETF of gold miners, though it has 20% silver miners in it too. But there's an event there that is extremely important. All of the primary entry points to go long silver that we have recommended are well below the market. So in other words, if you're buying silver now, yes, you're probably doing the right thing. But on the other hand, you've really missed the opportunities that came starting in 24, 25, and in late 25. There were 3 buy signals. The average price of those 3 buys was $38. Okay. But there is another technical that's about to snap into place, we argue. And when it does, the temper and tone and verticality of the gold, the monetary sector, especially the miners, will go absolutely crazy on the upside. And I'm going to argue that probably when that occurs, that's when you're going to start to hear the stuff that motivates your average latecomer investor into saying, gosh, I got to own some of that. And it's like a wet bar of soap time. Grab that thing. The spread relationship, the relative valuation relationship of miners to an ounce of gold, you could plot that thing. We go back and use XAU index, gold and silver miners index, Philadelphia, because it goes back to the 1980s. So we've got a lot of history there. And when you plot it, you'll see that if you divided the price of the XAU index into an ounce of gold, that during the 1980s, 90s, 2000, up through 2008, the average was 25%, meaning that XAU was at least 25% of an ounce of gold. It went up to 35 at one point and it got as low as about 17, 18%, but it lived in a range for decades, the average of which was 25%. Okay. In the bear market that ended in 2015, that spread collapsed to 4%. I mean, okay. Average 25%, it went to 4. I mean, what do you think? We don't need gold miners anymore or silver miners? We'll go to 4%. It's like free. I mean, what do you want? Okay. It lived in a range for the past 12 years between that 4% low, never went back there again. The lows after that were 5%. To about 8.5% on the XAU divided into gold. So you had this huge collapse and then this dozen-year wide perfect little range that when you plot it on a chart, you say, oh boy, break out of that and I'm going to buy it, okay? You're pushing up toward the top end of that again. You were there in February and then the miners pull back relative to gold and in net price. And now they're quickly asserting themselves back up. Now when we run GDX, which is the more popular gold ETF. Its top end of its 12-year range is 2.2%. Okay, divided into an ounce of gold. Right now it's back above 2%, charging toward the 2.2. If you get a monthly close on those spreads above the top of that 12-year wide range, there is a technical void in that chart where you could double the price relative valuation of the miners to gold just to bump the bottom end of the prior multi-decade range. In other words, go back to the old lows. Okay, is what I'm saying. You would more than double the price, the relative value. Now, there's another fact in that spread. And this is important. This is why it's net price important, not just relative performance important. Whenever the miners are beating gold, even during the swings within that little 12-year wide range, with upswings and downswings, whenever it goes up, it means also that the net price of both is going up as well. It's never the case that the miners beat gold in a down market. So when that spread breaks out, it's also telling us not only are the miners going to revalue themselves rapidly and large, but they're likely to do it with extreme speed. So all this fits into what we were talking about before, about an acceleration, a catch-up, new reality for silver. The same is going to be true with the miners. So while gold is the mama, and silver does move with gold, people say, no, it's not, it doesn't move. Silver does not correlate to the commodity index. It correlates to gold swings. So that's an error on their part. But anyway, I think that's the stick of dynamite you got to watch right now, is the breakout of the miners on a relative basis, spread basis versus gold. When that occurs, I think it's helmet time, and you'll see a lot of latecomers suddenly rushing in. They'll start hearing the headlines that we already know exist. The earnings are off the page. The profits are off the page for the miners, and yet it's been ignored.